CAPR fell 64%. 3 days later, it cratered again to a fresh 52-week low. Same stock, same FDA decision, 2 separate crater days. What's up, guys? Coach B here. I'm making this video because this is one of the cleanest examples I've seen of how a binary FDA event actually reprices a stock, and it's not the way most retail traders think it works. Quick background. CAPR Therapeutics, ticker CAPR, is a cell therapy company. Their lead drug, Deramiocel, treats cardiomyopathy and Duchenne muscular dystrophy, a rare and brutal disease. The whole company's value was riding on the FDA's advisory committee for this drug. Here's the setup. Late June, CAPR was trading around $24 a share. By July 24th, Friday, it had drifted down to $19.70, just normal pre-catalyst chop. Then Monday, July 27th, the FDA released its briefing documents ahead of the advisory committee meeting. This is leg one, okay? Reviewers found no statistically significant benefit versus placebo in the phase 3 HOPE-3 trial. They flagged post hoc changes to the statistical analysis plan, meaning the company appeared to have adjusted how it measured success after seeing the data. And they noted hypersensitivity reactions in 41.5% of patients on Deramiocel versus 15.4% on placebo. The stock gapped down at the open and closed around $7, down about 64% in one session 2 days before the actual vote even happened. That's the part most people miss. The vote hadn't even happened yet, and most of the damage was already done. The market read the briefing document and priced it immediately. Tuesday, July 28th, the stock slid a little further, closing around $6.57. Then Wednesday, July 29th, the actual advisory committee vote. The panel voted 3 in favor, 9 against, 0 abstaining on whether the evidence supports Deramiocel's effectiveness for this indication. 2 things matter here. 1, this vote is non-binding. The FDA doesn't have to follow it. 2, the question the panel actually voted on was narrower than what CAPR is asking for. It addressed a specific cardiomyopathy indication, not the broader benefit risk picture. That nuance rarely makes the headline. You'd think if the briefing docs already did the damage 2 days earlier, the vote itself would be a formality. It wasn't. The next session, Thursday, the stock opened down more than 50%. At 307, dipped intraday to 296, a new 52-week low, then clawed back some ground to close at 419, still down about 36% on the day on almost 29 million shares traded. So even though the briefing docs pre-priced most of the bad news, the actual vote confirming the reviewer's read still triggered a second brutal leg down. So here's the lesson. Retail traders treat the vote day like it's the whole event. It's not. On a lot of these FDA advisory committee setups, the briefing documents, which usually drop about 2 business days before the meeting, do a huge chunk of the repricing. But that doesn't mean the vote is nothing. If the committee confirms what the reviewers already found, you can still get a second crater, especially with a lopsided vote like 3-9. Read the whole calendar, not just the headline date. Let's look at where this chain sits right now. CAPR closed at 419. The August 21st options, 21 days out, have their at-the-money strike sitting right at $4. The 4 call last traded around $1.06, implied vol over 350%. The 4 put last traded around 95 cents, implied vol over 260%. Add those 2 legs together, about $2 combined on a 419 stock. That's the market pricing a move of roughly half this stock's value in either direction in the next 3 weeks. And look at the FDA's target decision date, the PDUFA date. That's August 22nd. The August 21st options I just showed you expire the day before that. Anyone holding that expiration is out of the trade before the actual decision even lands. If you're reading an options chain into a binary FDA catalyst, that's exactly the kind of detail you have to check, because it's easy to think you're positioned for the news when your contract actually expires first. I'm not telling you which way this goes. I have no idea what the FDA does with the PDUFA date, a non-binding 9-3 vote against, and reviewer concerns already on the record. What I do know is both sides are already in this chain. Some traders bought dirt cheap 20 strike calls today, way out of the money, betting on a shock approval bounce. Others bought cheap 3 strike puts, betting this thing is worth close to 0. That split is what a binary, already cratered chain looks like. Quick reminder, this is education, not financial advice. I'm not telling you to buy or sell anything. Do your own research. If I were framing this by time frame, a day trader is watching this chain purely for volatility around the PDUFA date, not conviction. A swing trader might wait for the dust to settle and the chain to calm down before doing anything at all. And if you're a long-term investor, this is the kind of binary single drug biotech risk that reminds you why position sizing matters more than which way you think it breaks. That's the breakdown on CAPR. 2 legs, 2 different information events, 1 brutal month. Drop your questions in the comments. And if you want more of these deep dives on the names actually moving, subscribe. Good luck in the markets, no matter what stock you're into.